All right, let's dive into the 2025 results for CapitaLand Integrated Commercial Trust, or CICT. If you're an investor, you're going to want to hear this because we're going to unpack what all these numbers really mean for your wallet.
So the headline number, the one that really got everyone talking, was a 9.4% jump in the payout to investors. We call this the distribution per unit, or DPU for short. It's basically the dividend you get. And folks, a nearly 10% raise, that is a very healthy sign indeed.
Okay, so what's the secret sauce here? How on earth did CICT pull off such a strong return for its unit holders, especially in this economy? Well, let's get into it and find out.
Here's how we're going to break it down. First, we'll look at those juicy payouts. Then, we'll peel back the onion and see where the money's coming from. After that, we'll get into the really clever strategy they're using, and finally, we'll take a peek into the crystal ball and see what the future might hold.
So let's start with the most important part for any investor, the bottom line. What did this strong performance actually mean for the people holding CICT units? And just so we're all on the same page, that DPU, the distribution per unit, is the cold, hard cash that a real estate investment trust, a REIT, pays out. You can just think of it as the dividend you get from owning a piece of their property empire.
And would you look at that? The payout for the second half of the year shot up to almost 6 cents per unit. That 9.4% increase is a massive signal of strength, especially when you consider how tricky the market's been lately.
A bigger payout is fantastic, right? But the smart question to ask is why? What's going on under the hood that's driving this growth? Let's dig into the numbers.
First up, we've got gross revenue. Now, this is basically all the money coming in the front door from things like rent. And that number grew by a solid 4.7%, hitting more than 831 million Singapore dollars. Not bad at all.
But here's the number I find even more impressive. Net property income, or NPI. This is what's left after you pay the direct costs of running the buildings. This number grew even faster, up 6.8%. And you know what that tells us? The business isn't just getting bigger, it's getting more profitable.
And this is where the story gets really good. See, the growth wasn't just a simple case of everything going up. It was more of a masterclass in balancing things out. On one hand, you had new income from massive properties like Capita Spring boosting the numbers. But on the other hand, they actually sold the property, 21 Collier Quay. This wasn't a setback. It was all part of the plan.
And that sale we just mentioned, that's the perfect window into CICT's core strategy. See, they're not just sitting around collecting rent checks. No way. They are actively, and I mean actively, managing their portfolio of buildings. They use a pretty fancy term for it, portfolio reconstitution. It sounds complicated, but the idea is actually simple. Think of it like a pro sports manager. You're constantly trading players, maybe letting go of a solid veteran to bring in a young superstar who's going to win you championships for years to come. That's what CICT is doing with its buildings. And you can see this strategy playing out in real time right here. They sell one part of an asset, then they turn around and buy a more valuable piece of that same asset a few months later. Then they sell an entire mall, and in the same breath, win the rights to build a brand new development. It's a constant, strategic churn of selling, buying, and building for a better future. The sale of Bukit Panjang Plaza for $428 million is the perfect example. That's a huge pile of cash that's now unlocked, ready to be poured into their next big, high-growth project. It's just smart business. So this active approach is clearly working for them today, but as an investor, you're always asking, what's next? So let's look at what's coming down the pipeline, both the opportunities and the potential storm clouds on the horizon.
Okay, looking ahead, there are some serious growth engines ready to fire up. They're not just buying new properties, they're upgrading the ones they already have, like adding cool new restaurants and shops. They're also spreading their wings overseas with a new property in Germany, and they've got a massive new development planned at Hougang Central. Lots to be excited about.
But of course, it's not all sunshine and roses. You've got to keep your eyes open for the risks, and there are two big ones to watch. First, if the broader economy takes a hit, that could hurt demand from tenants. And second, and this is a biggie for any property company, is how sensitive they are to rising interest rates. And to show you they're not hiding from this, CICT actually did the math for us. For every single percentage point that interest rates go up, their annual payout to investors would likely drop by about 0.35 cents. Now, that might not sound like a lot, but believe me, those little bits can add up fast. So after all that, what's the one big idea you should walk away with? What's the final takeaway when you think about CICT?
You know, I think their own CEO put it perfectly.
The key thing to remember is that CICT is not a passive landlord. They are active, agile managers, constantly tweaking and reshaping their collection of properties to roll with the punches and, more importantly, to find the next big opportunity for growth.
This content is intended to serve strictly and only as an informational, independent, objective summary of recent events and should in no way be interpreted, construed, or relied upon by any party as inside information or financial advice.